thought payments should be as easy as building an e-commerce site is. We saw that it was fairly complicated and hard for a small company or side project like ours to get payment acceptance. But in India, things were the other way around. Almost everyone in the ecosystem was facing this problem. A lot of startups will come up in the country in the next 5-10 years. Everyone will need payments. So if we built something in this space, we could provide it to so many startups and we could grow with them.
Both were first-time founders at that time?
Yeah, we were fresh out of college. We were inexperienced. We didn't have too much weighing on our shoulders, and we thought, let's give it a shot.
If you're a founder trying to think about what to go after, is the answer just pick 2, 3, 4 areas and then one of them might work out?
Yeah, or is that adaptable? You have to pick one area. Yeah. Try to go deep there, but also try to learn, like, if it's not working, why it's not working.
You're known for 7 days a week. How do you think about building a positive culture where people are working so hard all the time? Thanks, Harshil, for doing this. We're so happy to be in business with you guys as one of your investors at Lightspeed here. The series that we're doing, Lunch with Lightspeed, is about talking about founder journeys and how they started and key decisions they've made along the way. So we'll talk about that as we go along, keep it informal. Maybe one place to start is sort of when Shashank and you in 2014-15 were thinking about starting a payments business. At that time, Flipkart and I think Snapdeal and many other e-commerce companies were growing at that time. There was a lot of cash on delivery. Yeah. You know it better than I do at that time. How did you think about whether to start up? And then there were also larger companies out there, your BillDesks of the world, and I'm sure other payments companies. How did you think about starting up in this very crazy atmosphere of that time? It was kind of like 2018, 2019 even. There's an up-ramp, lots of capital. How do you think about that? And we're trying to sort of draw journeys, founder sort of lessons for other founders out of this. So we can generalize a bit later, but just how did you think about it at that time?
Yeah. So first of all, like when we started building this, I don't think we had thought of a startup or building a business around it. It started as a problem that we faced. So both me and Shashank were in a large MNC jobs. We used to have a lot of free time and we didn't have much of a life, so we didn't know what to do with the free time. So we used to code like a techie. So we used to build stuff on the side. And for one of those things, we had to accept payments. And he thought, yeah, let's just get something and put it. Like we thought payments should be as easy as building an e-commerce site is. Yeah. And we saw that it was fairly complicated and hard for a small company or side project like ours to get payment acceptance, digital payment acceptance. It was much easier to accept cash than digital payments. Yeah. And that just made no sense to us. Like point of most technology, things like internet, social media and everything has been democratization. That social media gives everyone voice, internet gives everyone access to information and so on. And similarly with payments, like digital payments, one of the point is democratization, that anyone can accept money easily, cheaply, efficiently versus cash, which only large companies can do and manage and handle the complication. So, but in India, things were the other way around on payments. So it was easier to accept cash. It was easier to do COD than to do digital payments.
And this was before UPI.
Yeah, this is 2014.
This is early.
Yeah, 2014. Yeah. So that was not a surprise that COD volumes were larger than digital volumes in most e-commerce places, because it was easier and most startups we knew started by accepting COD, cash and other things, and that made no sense to us. So we tried to figure out why is this complicated. So we tried to ask other founders, and we used to, that time Facebook groups were very popular, so we used to go to Bangalore startups, Pune startups and this Facebook groups and just hang out there, ask people what are they doing, how are they dealing, and everyone had the same problem. So we thought we were not an exception. It was just the way things were. And we, in our typical techie mindset, were like, how hard could this be? Like, why does nobody solve this?
Yeah.
And we used to look at like global examples, like companies like PayPal and Braintree and Stripe and others. It was just easy. You just sign up. It's an API. You integrate it. Like it was as simple as using AWS. It was that simple to use digital payments.
Yeah.
So I think it was our ignorance or whatever you might call it, but we just were like, hey, this doesn't sound like a hard problem. Somebody should just solve it. So we started.
This is your own problem, basically a problem you were facing yourself, and you wanted to solve it.
And we saw that everyone else was facing it, and we thought that, hey, this seems like a big enough opportunity. So we started spending more time researching it. We just trying to find the core of the problem and spend a lot of time reading up regulations, complications, why does this happen this way, what is needed to build something like this. And more and more we could convince, yes, it is not easy to solve this, because unlike e-commerce or something, you can't just build an app and launch it. We had to get partnerships and apps. But the reward seemed worth the risk, because almost everyone in the ecosystem was facing this problem.
Yeah.
And this is 2014, startups were coming in. The largest startups were probably Flipkart, a couple of $1 billion, but most startups were fairly small.
Yeah.
I think Zomato was just hitting some small scale at that point of time. Swiggy was just getting going. So we felt like, hey, we saw that trend that, hey, a lot of startups will come up in the country in next 5-10 years. Everyone will need payments. Like, you can't have commerce on internet without payments. So we're like, hey, if we build something in this space, we could provide it to so many startups and we could grow with them as some of these grow.
There's a question for you there. You both were first-time founders at that time?
Yeah, we were fresh out of college.
Fresh out of college.
Almost a year out of college.
So did that weigh on your mind in any way, that we haven't done this before and what are we going to do?
I think the ignorance.
What was the defensiveness, if any, at that time?
The ignorance played to our strength.
Okay.
Because we didn't overthink it. Like any techie coming out of college, you're like, this sounds easy. Why is nobody doing it? Of course, it wasn't as easy. And maybe in hindsight, if we knew how complicated and painful it is, maybe we didn't have taken the call. So I think overall, it is good that we were inexperienced. We didn't have too much weighing on our shoulders, and we thought, let's give it a shot. Let's see where it goes. And so we started spending a lot of time building, getting bank partnerships, trying. I remember, like, we had no idea how to approach the bank side of things. So I remember I was at my hometown in Jaipur for a holiday, and I went to the bank branch next to my home and just said, hey, I want to start a payment gateway. How do I go about it? And the guy looked at me like, do you want a payment gateway? We can give you one. I said, no, I want to start my own. How do I? And nobody walks into a bank branch and just asks.
A branch,
so,
yes.
Yeah, but I didn't know anyone else. So these guys like connected me with somebody in Delhi who looked at this. Then we had to send them a business plan, and we did a lot of effort, created something, sent it to them, got rejected. Then did the same thing with another bank, then found a senior to the guy who rejected us, reached out to him, and then found a senior to him, reached out to him, found other teams. So it was so on the parallel, we started building the product. Like, we didn't know how the bank APIs would look, but we said, how would a customer expect this? So one side was this, how complicated the onboarding process was. The second was the tech that was available on digital payments was extremely poor. So typically, if you wanted to integrate a payment gateway, you would reach out to a company or a bank. They'll send you a large PDF, about a 40-50 page PDF, and then a sample code that integrated this way. And it was like it was sold as if you're selling like a baked in product. But payments is not done like that. Every company has their own unique way that they want to accept payments, their unique flow that they want to accept payments. An e-commerce store is different than a subscription platform, is different than, let's say, a utility company, is different than somebody who's delivering goods on the fly. So it's very different. Somebody has cross-border needs, somebody has this. So that was one.
Okay, so when founders start companies, we find that technology can do anything for anybody. So it's very important for them to pick a wedge and a sharp pain point to go after. I can imagine in payments, all these use cases you talked about, from offline sort of to online, and all sorts of permutations and combinations were there. How did you think about the wedge? And anything generalizable from there for founders in general?
I don't know, a bunch of stuff that we tried, and a lot of them worked, a lot of them failed.
Yeah.
So when we started, we focused on the product side. We were fairly clear that, hey, it has to be an API-driven product. That's how globally it's done. And I don't know why it was not happening in India. So we took an API approach where it is flexible, so we can move it around into use cases. But from a GTM perspective, we picked specific areas. So we picked two big areas. One that we picked was education, where we felt that education payments are mostly cash, mostly non-digital. We thought and it seemed like a very large use case.
Yeah.
So we'll go after education institutes, because simple back of the math, that large volumes, small percentage, easy revenue, easy profitability, we can go from there.
Okay.
Right? That is one thing. The other side, we said, okay, because we're building this and startups are the ones that we know well, so we'll also try selling to startups. But that was secondary. The primary was education. And mathematically, it sounded like education is a big market. We should make more money there. Of course, things are very different in practice.
Yeah.
So went to a bunch of education institutes. We'll meet a lot of them. A lot of them were very excited. Not a single deal closed, at least in the 3-6 months that I tried. Not a single one would say yes. They would all say yes, and they're interested in everything, but nothing would ever go to actual closure, actual go live. We would kept getting along. It was like typical enterprise sales. We were meeting one team, then another team, then another team, but nothing would ever actually go live, and we didn't know how to take it live. We didn't have an enterprise sales experience. On the other side, because we're building and we knew startups, and that's how we discovered the problem, we started selling to startups. And while the volumes are low, there were closures happening. We were taking startups live, we're taking 20 startups live, 30 startups live, 40 startups live.
Yeah.
Every day there were more and more startups going live with us. So what seemed right in the Excel sheets didn't really work out well, because all the math and everything on education was great, but in practice what we realized is that education institutes didn't really care about digital payments.
Yeah, the incentive wasn't there. Yeah.
Yeah, so they were like, I don't care how my person pays. If you have a child in a college, you'll find a way to pay its fee. It doesn't matter whether they offer digital payments or not. If you have to pay by cash, check, they ask you to do a bank transfer, they ask you to come to their college and pay, you will pay, because the priority is education. Versus in startups, there's a delta, because the commerce companies, like an e-commerce companies, could do a lot more volume.
They want to reduce friction and just...
They reduce friction. If you can go and order right now versus offering for COD, it reduces their cost, So there's a real pain point. So we got much more traction there. So we did this for 6 months, try to do both, actually more priority on education. 6 months later, we realized this is not happening. Let's put all our efforts on things that are actually winning. We put all our efforts on startups and young companies. And we got a lot of good traction there. And we slowly started building from there.
So then in hindsight, if you're a founder trying to think about what to go after, is the answer just pick 2, 3, 4 areas and then one of them might work out?
Yeah, you have to be adaptable.
Is there any science behind it at all?
I think you have to be very adaptable. Like, you have to pick one area, try to go deep there, but also try to learn, like, if it's not working, why it's not working? Is it not working? See, the typical founder mentality, product founder mentality that we also suffered with is, you keep thinking that, hey, if I had one more feature to work, you don't really go back and understand why is it not working. The features are never really the reason. So initially we only offered cards, and like a lot of these guys said, hey, if you also have net banking, we'll go live with you. If you also have this, we'll go live with you. If you had a school management system entirely, not just payments, we'll go live with you. We actually built the entire school management system. We realized it doesn't really matter. The reason this is not happening is because they don't really care about the problem itself. Yeah. They don't care if somebody pays digitally or somebody pays. I went to a meeting with a school education owner. He's a very big guy in Jaipur, and he owns like almost 30, 40 institutes. And his simple question was, how much are you going to charge for digital payments? I said, about a 1%. He said, if my parent is willing to pay 1% more, why should I not charge it myself and remove digital payments? Like, if he's willing to pay 1% more.
So they didn't see the value.
Yeah, so like, if I can earn 1% more, I'll earn 1% more directly. I don't really care about whether the guy pays digitally or not. My parent will come and pay no matter how I ask him to pay. And that just opened my eyes.
There's a similar concept we have in enterprise software, where when you're selling to businesses, you can always keep getting asked for a proof of concept and ye feature add kar lo, wo feature add kar lo.
Yeah, if it's solving a real pain point, none of these things matter.
Yeah.
If it's not solving a real pain point, you'll keep finding more things to do. You'll keep finding one more feature, and that's a standard product founder issue, that you feel one more feature and it'll get all the traction. It never does.
And what we tell our founders, and what the best ones end up doing, is they talk to the business, the person who's got the business incentive and has some strategic initiative in the business that they're responsible for. And if this helps them on that, then
you should be solving at least one
done.
Individual's problem who's a decision maker there. Who takes it up. So startups, we didn't have as many features as most of the large payment companies. We didn't have as many instruments supported and all of that. But the reason startups went live is we solved one simple problem for them. We could take them live within a week. Today we do it in a day, but at that point we could take them live within a week. Most payment companies used to take 2 to 3 months to take live. That single proposition was enough for them. They didn't really care. We didn't have any instruments. We had the worst pricing. We didn't have as many in-depth features, but we could take them live within a week.
Sitting in 2025, and you look back at sort of all the B2B selling that Razorpay does, what is the methodology that's emerged to really crack at a high level? Sort of what is the one concept that a founder should keep in mind now, given the learnings you've had over the last decade?
I think one of the biggest things in B2B selling is, I think you have to find your unique niche. But one of the biggest things you have learned is that the biggest difference between B2C and B2B is, in B2C, people are looking for an opportunity. In B2B, people are looking to hedge risks, right? So that's the big difference. So if I go to you in a B2C company, like, as a consumer, and say, hey, I do this thing, this is really good, better than what you do, you are willing to buy for that. On B2B, the biggest challenge is risk.
Risk management.
Like, you are great and you solve a big problem, but what if you go wrong? So because the worry for the guy is, I shouldn't lose my job. So it's not about, did I do something great for my company? It doesn't really matter most of the days. But if you go wrong, I lose my job.
So
how do you solve for that?
The takeaway is don't just address the business value for them, also address how you're going to mitigate the risk.
How do you make it risk? The biggest worry, so you have to tell that, hey, you serve these many customers, you serve this, you have to show how this will not go wrong, or if it goes wrong, how will you be on their side all the time. So I think that is the big delta, and that is sometimes hard to grasp. Hey, I'm solving and doing this amazing thing for you. Why are you not buying me? Generally, the answer is so. It's a standard thing. Nobody got fired for buying IBM.
Exactly.
Because
I think this is something a lot of startups, B2B startups miss out on. They just address the value and ROI. They forget to talk about the risk perception that the buyer has of your startup.
Yes. Yeah.
Okay, just moving on. And, just in terms of timeline, 2015 you launched and you raised your first round of financing from Matrix and Tiger. 2016, you touched $1 billion in GMV. Amazing growth in just a couple of years. Lots of different integrations on the back end. 50,000 merchants is the data we have. At that time, you're now talking about 2015, 2016, there weren't a ton of startups that had sold into SMEs in India. And startups are a type of SME in a sense. What is it? And there's conventional wisdom out there today that you can't make money from SMEs. They don't pay for stuff.
Yeah.
What is your learning on that front? What do SMEs pay for? Because of course they do pay. So how does that work in India?
If I talk about how do you build an SME company in India, so the standard approach, you can't approach SME like enterprise sales. So you can't go and do a push sales. If you do a push sale, your CAC LTV would never work out.
Push meaning showing up at
calling,
the merchant saying,
reaching out, asking, hey, do you want a payment gateway? This is ours. Because the cost of reaching those customers is going to be higher than the LTV will make.
Okay,
Most SMEs in India are small, especially digital SMEs. We are talking about purely digital. So the volumes that they do, especially payments being a thin margin business, the LTV CAC doesn't work. So how do you approach that? I think one of the things that we did in payments, and payments is considered an unsexy business. It's in the background, it comes up and gets done. Nobody knows. Most payment companies are unknown. The approach we took was we tried to create a brand in this space. So what we did differently is when you pay via Razorpay, you'll know that you are paying via Razorpay. And that is one thing that differentiates us even today. Anytime you're paying via Razorpay at any website, you'll know. And the way you know it is we have a very sharp, quite different looking logo, very sharp colors. Our checkout form shows up, Razorpay is shown front and center. Even if it is for a second, you see Razorpay there. At the completion of our transaction, we started sending an email. This was no payment company used to do that. We started sending email to every customer. They successfully completed this transaction on this website. Merchants liked it because it gave a final confirmation of payment to customers. So if your money is directed, you know at least the payment gateway has recognized it, even if the website hasn't. So it solves that problem. But the reason we started doing it is because it helped us create a brand.
Okay.
Every time you pay via Razorpay on any website, you'll know you have paid via Razorpay. And that brand building happened slowly and steadily, but it started happening. So when we had 20 merchants and 30 merchants and 100 merchants and 500 merchants and 50,000 merchants, suddenly people saying, hey, I see Razorpay everywhere. And they say, yeah, are you guys everywhere? The reason they saw Razorpay everywhere because no other payment company was seen. So we were still fairly small. We had like hardly 2-3% of the market. Every other payment company had much larger market, but they were always in the background. So even though you were paying 50% of the time with other payment gateways, you never realized it. But when 5-10% of the time you see Razorpay, you realize it. And you say, hey, Razorpay is everywhere. Razorpay is the only payment gateway. And
so that helped with SMEs as well.
And that started helping with SMEs. So our inbound funnel grew rapidly as we started scaling. So we used to do push selling to the mid-market and larger clients. But as we started scaling there, as more and more customers went live, our inbound kept going up. One of the biggest metric that happened in 2018 is payment gateway is the auxiliary standard keyword search on Google. So everyone targets payment gateway as a keyword. You're doing performance marketing, and most brands are smaller than the keyword. So most payment companies, the search volume for them is smaller than the keyword. In 2018, we overtook that keyword. So Razorpay became a more searched word than payment gateway on Google. And that means that we were able to build a brand that we basically able to create. Razorpay is the brand stronger than the category. And today that exists and that's like larger. So today Razorpay search volume is almost 2x or 3x of payment gateway as a search term because we created that deep brand.
So it sounds like mathematically almost bringing the CAC down dramatically helped you make money even in a very value conscious sort of SME market.
So we changed the push sales because that doesn't work on SME to a pull sale where people would search for Razorpay and land up to us. And at that point, the LTV CAC works because the CAC is zero.
I feel that's a lesson out of the last 10, 15 years in India where you can imagine coming up towards 2019, 2020, the funding volumes were going crazy, and most startups were spending on Google and Facebook.
Yeah.
It was in my opinion, a wholesale wealth transfer from VCs to Google and Facebook, as far as I could tell.
It's just good to start with, right? I'm not saying
good
that
to start
we
with.
also did it at the start, but
I
at some
think
point you have to have a way to reduce it.
Yes, and I think what's happened post-pandemic, and we're seeing this in the newer startups that are coming up. We did back, for example, PhysicsWala last year, which has famously got 80 million visitors to their YouTube website. So a lot of different people have worked out a very low CAC or organic way of acquiring, rather than relying on Google and Facebook and just spending more and more and more.
Because somebody else will always outspend you. You can't win on that. That's not your moat. So it's good to get started. But what's your moat? Your moat is your brand or your product. And that's where I was coming to. The second big moat that we built was product.
Okay.
Where we built the product to that extreme finesse that once a customer uses Razorpay, they'll keep using Razorpay. So going to a B2B selling, a lot of times people feel B2B is one-time sales. Actually, it's not. You sell to a guy, a product manager in one company, you started using Razorpay. We saw a bunch of times the product manager will shift to another company and put Razorpay there. Shift to another company because I used Razorpay there. It was really the best thing I did. Let me put it here as well because I know that gets me a win inside the company. So the payment guys, the payment heads, will, as they move companies, they'll put Razorpay because they know that this got them a win inside their company. Hey, I improved my success rate by 10% when I put Razorpay. Let me put it here as well. It's an easy win. I can show to my management in 3 months that, hey, I improved a success rate by 10% just by changing my vendor. So that became the second big mode for us, which is the product mode. Those are real modes. Like as you said, like Google and Facebook is good to get started, but what is your true mode? So for us, that became brand and product.
Makes sense. Just moving on a little bit, we're now into 2018. You've raised a bunch more capital, 100,000 registered merchants and more. And now you start launching sort of other products out there, neobanking, payouts, GST tools, things outside of regular payments. One of the first payments companies to do that in India. I feel a lot of technology startups, sort of founders, face this issue also. They ramp with their first wedge product, and then at some point they have to start thinking about other products out there. Sometimes they do it too early and have many products with very low revenue. Sometimes they do it too late and lose out the market to somebody else who's built out the other products. How did you think about being one of the first companies in India to sort of add all these different things? It feels like it's paid off now, when you look in hindsight, but at that time you wouldn't have known, right? So what was your thinking at that time?
I think the first thing is like we needed to deepen the relationship with the customers that we serve. So in India, it's hard to, in US it happens a lot, but in India, hard to build thin layer products because people want to trust one core brand and they want to do everything with one brand. It's a trust deficient market. So if you find trust with one brand, you want to go wide with them.
It's like the Tatas are in all the way from
the same company will sell a salt and a car because you concentrate trust with one company that you trust, right? So if you're a thin layer company, it's easy for you to lose because the depth of the relationship is not built. So if you're just, let's say, a payments company for us, then that layer is very thin. Somebody else who does a bunch of other stuff and also does payments will win long term because they'll be able to concentrate their trust that, hey, I do everything for you. Let's say a bank or something like that. So we wanted to go broader there. The second thing is that we have to follow the customer's problem. So one of the common things I do even today is I will meet at least one business owner every week. I still do it. And I'll ask, the most important question I'll ask him is, what are other problems that you think somebody like us could solve? What are your other challenges? One of the common problems we heard is that, hey, you accept payments for me digitally. Like a lot of SMEs say, accept digital payments, great. But everything else I do downstream is not digital. So I don't really care about digital payments because even when you pay into my bank account, I have to withdraw it in cash, I have to cut checks, and I have to do a bunch of payments to my vendors, to my suppliers, and so on. That doesn't happen smoothly. Then I met companies who had to do a lot of payouts because they'll meet, let's say, cab aggregators, food delivery companies who had to do payouts to vendors, restaurant partners, cab drivers, marketplaces who had to do payouts to vendors. They said, yeah, payments is sorted, but this is another problem that we face. So that whenever I would ask that question, I'll see what is the common theme. And one of the common themes that came is that accepting money is one part, but what happens downstream? Can we solve for that as well? That will deepen my relationship with these merchants because I'm solving multiple problems for them. So that's how we went into building Razorpay. We started building on payment links, payment pages, because a bunch of these guys wanted more than just a pipe for payments. So that's how a lot of these products came out naturally. It doesn't mean you build everything that the customers ask for, but you find common pain points that are widespread enough that if you solve for them, you're deepening a relationship with at least 30, 40, 50% of the merchants that you work with. And that's what started happening for us. So we started building a lot of these stuff on the sideline. of course, the core still is payments. I'll say still the core is payments. So we never reduced focus on that. But you put 10, 20% of your bandwidth on some of these things, and if one of these scales up, then you go deeper. So we built 5, 10 different products. Some of them failed, and we shut them off. A lot of them went deep, and then we kept going deeper with them.
It's such a key insight especially for the India market, that brand means so much. And if you have brand in one area, you can extend it to other adjacent offerings and even.
But it doesn't apply everywhere, right? So, for example, we never went into consumer. Right? Because the brand that we had was very deep and broad, but it was with merchants.
B2B, yeah.
So now if I build a consumer stuff, maybe I can do that, but I cannot learn brand. Then I have to build some other wedge to get there. Consumers didn't really care about what payment gateway is being used. Only business owners did. And this is what I learned by talking to them, that no consumer would ever notice which payment gateway you're paying from if you had nothing to do with payment gateway world. But business owners would look at it. And that's where we had the brand built out. So you need to know where your brand exists, and then you can go wider on the brand.
And widen it, yeah. I think the other thing that you said that really rings true for me is just visiting with and meeting customers very, very regularly and just asking them, how can I help you? What else can I do for you? What are your other pain points?
That's one advantage
a lot
of
of
B2B
founders
has.
sit and just in their office and build more stuff. But if you're in the field, you just learn so much.
And I give this advice to a lot of B2B founders. Like if you're a B2B founder, you cannot say, I don't do sales. You cannot. Like if you're 2 founders, you have a large leadership team, every single person does sales. And sales doesn't mean selling something. Sales means meeting customers, asking them what they need, asking them, am I doing good enough? What more can I do? Like you cannot be a B2B founder if you can't meet your customers. That's one biggest advantage that B2B companies have over B2C is you can sit across your customer and ask them, am I doing well? What more can I do? It's hard for a B2C company to do that because the customer base is so widespread. What one consumer say might not extend to others. In B2B, it's very limited.
I think the trick here is in asking an open-ended question. What more can I do for you? Rather than saying, I have something else to sell you. When you leave it open-ended, they can then unload in terms of their problems.
Hey, if you solve this, I'll be very interested. If you solve this, and then you can go back and say, hey, you told me this a year back. Now I have this as well.
Let's move on to 2019. You started doing some smaller acquisitions at that point. Can you talk about some of these acquisitions? You may just in terms of areas very quickly, but then really what I want to get behind is why M&A? What stage of a company it makes sense to start doing M&A, tuck-in acquisitions of other companies? How did you think about starting M&A?
How do we maximize that further? And that's where M&A started playing a role. So we looked at products that we could add. One of the things, for example, the first acquisition that we did was on the payroll side. And the idea was that this is another capability that if we add to Razorpay platform, I can distribute to the largest number of customers. But if I had to build this capability now in 2019, it will take me 1 to 2 years to just build it out. And then I'll start selling it. I'll be losing that ground. Somebody else would come up. So that's when M&A started making sense that, hey, you have a distribution advantage and I can get a product capability that I can add to the distribution and then scale it.
And you were sort of making a build versus buy. Build will take a longer time.
Build will take a longer time.
To buy, it might.
Most product companies are natural affinities towards build, and which is right. Naturally, I would want to build. Buy is always a complicated affair. So it has to be the right thing, built in the right way, fits with my brand, built in a way that it is actually scalable, all of those things. Then the team that comes with it, if it's a too large of a team, then you have to think of it as if you're taking a 50-member team, it's like hiring 50 people in one go. Will you do that? It's going to be extremely hard to be able to hire 50 people in one go. More complicated if it's 100 people, more complicated if it's 200 people. Can all 200 people fit your culture? Unlikely. And so it becomes harder and harder and more complicated from there. So at least the starting point for us was very, very small acquisitions. So like 1-2 people teams, which had built a unique capability that if we latch into tuck into our systems, we could distribute it really wide. And so the acquisition was payroll, which was a 2-member team. We did ThirdWatch, which is an AI fraud company, which is a 3-member team, and so on. Because it's easy to interview 2 people and say, both of them fit my culture. Let's get them. This product fits what we want to do, and I can distribute it far and wide. Easier. And as we did more and more of these small acquisitions, it built our comfort that we could get into large acquisitions. But the affinity first is always towards build. Prefer building if buying doesn't give you a significant stronger upside either in terms of time or value that you can't solve build. So the delta has to be like 40-50% more than what you would get by build. Only then it will make sense, because you will lose 40-50% in just the cohesion, getting things right, aligning everyone to the same culture, aligning policies, avoiding turbulence. A lot of people will not want to do this once they make enough money. So you also have to figure for that.
Incentives.
So incentives. So what, like there has to be a 50-60% extra delta that you get out of buy over build. Only then the equation would work.
Yeah, makes sense. I just wanted to step aside from going through this journey and the timeline that we've been going through from 2015 now in 2019. Just step aside to talk about sort of capital and how, as a founder, you've thought about capital along the way. And I'm not talking about the capital need at any specific time. I'm talking about just how have capital providers, the VCs, the growth VCs, and so on, interacted with you along the way. Where have they been most useful? What I'm trying to get out of this is, obviously founders think of investors as providing capital, but what would your advice be to founders to help them take most advantage of the investors beyond capital? Like what can they do to really help, to get that help, to help their business?
I think
any story around that somebody helped you?
So first of all, I think from a capital perspective, just from a pure money perspective, I think you should try to build a company in a way that you have the least dependence on capital at any point of time, right? So Paul Graham has this famous essay called Default Dead and Default Alive,
right?
Which means, is your company default dead or default alive? And you should aim to your company to be default alive, which means tomorrow it doesn't raise any round of funding, can the company still survive? And that doesn't mean it survives in the same way. You can change a few things around, but can your company survive with additional type of capital? I think those are the best kind of companies, both from a founder's perspective as well as from investors' perspective. Most investors want to invest in companies that are not dying for capital. That, hey, if I don't do the next round, the company will die. If I don't do the next round, the company will die.
And what does that company look like, a default alive company, apart from being profitable? But what
profitable
is
not necessary. It's just that you can get to profitability when you want it. So
what does that look like?
So for example, for a B2B company, it's relatively easier. Right? For a B2B company, if your unit economics are positive, but you're burning a lot of money on R&D, you're burning a lot of money on aggressive GTM, aggressive sales, which means that if tomorrow you realize that, hey, I'm not raising the next round, you can pause some of these things down, but the company will still continue to grow.
Because you have high margins.
Because you have decent margins, your unit economics are positive, you have decent margins, you reduce your R&D spend, you reduce your aggressive GTM spend, your company still grows. In our kind of company, that was always possible. Again, it's harder to do it in B2C because you have to spend a lot of money to first acquire customers and then you start making money. But in B2B, it's relatively easier. Okay. So for us, we always sold a positive unit economics. We had slight bit of aggressive push on R&D because we're building a bunch of products. But if, let's say tomorrow I learned that, hey, I'm not raising next round of funding, I could pause my new product build out. I still could serve the customers I have, still could get new customers coming in. And my inbound funnel will still continue, even if my outbound was paused.
I get it,
So that is a default alive company, and which means that you can survive if it comes to it.
So back to the capital providers, I understand the default alive, default dead thought process. What other ways can founders extract value from?
So if you're default alive, first is like there's always money chasing you versus you chasing money. So it gives you a better leg up in terms of evaluating investors. So it's related to the second question, because sometimes if you're really in that dire need of capital, then the second part doesn't apply. And then you have to take what money comes to your door. Yeah. But when you're in this position, it gives you the advantage that you can choose your investors. You can choose that, hey, I have 5 investors coming, I'm not dying tomorrow. I can pick the investor that fits me well on the second criteria. So that was the point I wanted to make, because you can't prioritize second over survival. Survival is first. Right? Now, if you have that opportunity, then you try to find investors who are first and most important is aligned with the vision that you're building. Because that, like, it's a long-term play. Most investors in an early stage will stay and sit on your capital at least for the next 7-10 years or more, which means you're building a long-term partnership. So just money today is not going to be enough. Right? You're going to be with them for 7-10 years of the company. Almost every of our institutional investors is still on the cap table and working with us. Right? So you're signing up for that long-term partnership. So that alignment to the vision. And second is like the advantages that you can get from those investors are, if they're aligned with the vision, then are they willing to go above and beyond to help you achieve the vision? And that's one thing that we have really used a lot. So again,
any stories in the early days of what helped you?
Every way. So we got into YC, we used that a lot, network a lot to get connected to multiple companies in the US. For example, in the early days, we wanted to get integration going with Shopify, right? And we didn't know anyone in Shopify. We were fairly small for them to consider integrating with us. So I dropped a message on my YC group that, hey, does anyone have to connect to Shopify? Then 10 minutes, I got connected to the Shopify CPO at the point of time. And we would live and integrate with them in a month.
So introductions.
That's the
is a
easiest
easy
thing.
one.
And again, if the investors are aligned with you and working to help you, then that happens a lot. Even today, we leverage that a lot. I know I keep pinging Lightspeed a lot. Hey, I need a connection to this company. I need a connection to that company. I saw that you guys invested in them. Can I get introduced there?
Yeah.
I think that's one thing, and I think there's no.
That's an easy one. Customer introductions, partnership
easy
introductions,
one,
and so on.
I think you have to be completely shameless about it. If the investors are on your cap table, they are willing to help you, and it's in their benefit and yours to do that.
I like to call it giving homework to the investors.
Yeah.
After every board meeting, or forget board meeting, anytime, you can give homework to the investors. Please do this for me, and then hold them accountable.
Most of my sales heads are connected to most of my investors, and they ask them directly that, hey, can I get into here? Can I get into there? And I think we've never shied away from doing that. I know I keep thinking Lightspeed a lot on that.
No, it's been wonderful.
The second is, of course, the advice and sounding board. I think that's where real value, and that's where individual matters more than the fund. Where which partner are you taking money from? Are they really aligned and committed to you? And do you trust their advice? And you should find somebody whose advice you trust, both for their sake and yours, like that. Because otherwise you'll have misalignment and only you're getting money, right? At the end of the day, most investment terms are that as a founder, you can do what you want. Investors can only give you an input.
Yeah.
But at the same time, if you're not getting that value out, you're losing something on the table. So find an investor whose opinion you trust and you'll respect. That doesn't mean doing everything that investor tells you, but you'll have somebody countering your viewpoints. You can still take your call. I'll give you an example. Like when we were starting, at the early days, we got a lot of inbound we got connected to a lot of large companies who wanted to use us. Like we got connected to a Flipkart, we got connected to some of these large companies, whether they wanted to use us or not, but they wanted to evaluate us. And we were confused. So for example, I met Flipkart and they wanted to use us, but they wanted like 100 other features before they could use somebody like us. And I was confused. Should I build this 100 features for Flipkart and try to take them live? Or should I build this 100 other features for 1,000 other SMEs and try to take them live? And it was a hard problem. As a founder, naturally my instinct was, let's build for Flipkart. Because if that comes, when account closes, my life is sorted for the next couple of years. Like I'll have a hockey stick growth, I'll have investment, everything, revenue. I don't have to worry about survival at all. And I met one of our early investors, Matrix, who gave this what he's called a rabbit, deer, elephant analogy. Where like, are you a company that chases a lot of rabbits? Are you chasing a bunch of deers? Or are you chasing one elephant? You can chase either of those, but you should remember that an elephant will be hard to chase and hunt. And if you take years to chase one elephant, maybe you're thinking, I get one elephant and sorted for life. But it's not easy to chase and close an elephant.
That's good advice.
Deers are easier, deers are relatively easier, make enough meat somewhere in the middle. And rabbits, you can chase a bunch of rabbits, but you'll always be hungry. So where do you land? And I think that made a lot of sense to us, and we spent a lot of time thinking about it, and we actually said no to build a bunch of stuff that Flipkart wanted, because we realized that even after 100 features, they will need 200 more. I don't think they'll actually have gone live with us at that point. We were fairly small for them. They were always this greed that, hey, we take them live, our life is sorted. But we were better off chasing these 1,000 small startups, which were actually going to go live with us if we did this one feature for this one guy, one feature for this another guy, and so on. And we went in that direction, and I think it worked out well. As we grew and became bigger, of course, Flipkart also went live with us. But there's a natural path where that made sense versus trying to unnaturally do it.
In the timeline, 2022 end onwards, this sort of RBI issue reared its head, where they were saying that you couldn't acquire new customers until some certain issues got resolved, and that's a pretty challenging issue for a company to face at any point, that you can't acquire new customers. And now that applied to the whole industry. So that's sort of a silver lining, if there ever was one. But really, you had to go through you didn't know, but it was maybe 15 months worth of uncertainty then. And how did you deal with that uncertainty? How did you talk about that uncertainty with your stakeholders, your employees, your investors, your customers? Because in an uncertain time, sometimes it's just human psychology to sort of pull stuff in, not say much. Why should not disclose much? Sort of just take care of the problem, then come out and say, problem solved, boss. So how did you? I do recall us talking at that time with AJ, my colleague, and others, and Vishnu and others, and you guys were very open about it. That this is a problem we're facing. Here's how we're going to get through it. Here's what we're doing about it. Can you help us in any way? And we went through it together. But a lot of instinct sometimes is to pull in and not say much. How did you think about what to disclose, what not to disclose? etc.?
First of all, as a startup, you should know this. Like, problems are part of the startup journey. Right? You'll have challenges, and if you're taking investors, like that's where the second part of the investor conversation comes in. If you're taking investors, you should find investors who understand this. A startup journey is going to be painful. Most experienced most experienced investors know this, that there are problems, there are challenges every startup faces, and they're mature enough to understand and work with you through that. So that's the first part, like having the right kind of investors who are mature enough to have seen the world, have done a bunch of these things, who knows and seen the journeys of the most successful startups, and they know that the most successful startups go through pain points.
Yeah.
Right? The second is, as you go through these pain points, you learn that I think the best way to deal with the issues is like you can't do anything about the issue itself at most point of time. Like you have to wait for it, but the best thing you can deal. It's not just about investors; it's also for your customers, for your partners, everyone. The best thing you can do is be transparent about it.
Yeah.
Right. So we face so many challenges on the customer side as well. Like for example, I remember the Yes Bank moratorium, when Yes Bank shut down, and a lot of our customers were impacted because they use services which were reliant on Yes Bank. Their funds were stuck with Yes Bank.
Yeah.
And the same approach we followed. We were very transparent. We actively communicated. We actually maybe we would have sent like 10 emails in that 124 hours window, explaining people that this has happened, this is the current impact, this is what we are working on. And we said again, that, hey, this is what we've solved, this is still the current impact. This is what we've solved, this is. You won't believe, like the next day, within the 24 hours, we had the most loving tweets and messages for Razorpay than we have had in the last. Like,
because you were transparent.
Because of the issue. Because these are the times when, like, same with investors and partners and everyone, when things are tough, that's the time when people are most passionate as well. So either that passion leads to hate or that passion leads to love. But that's the time when the person cares most about what you're doing. Most of the time, people are indifferent. Like most of the time in payment companies, customers don't care whether you're operating or not. As long as my payments are happening, it's fine. People don't even remember their payment gateway. These are the times when people do care. And you can use that care to your advantage, or you can let it be, and then it will go to your disadvantage. Natural is disadvantage, because naturally if you hear, hey, Yes Bank is down and Razorpay stopped working, you're like, what is Razorpay doing? What is happening with them? They're by default hating you if you're not doing anything about it. But when we are transparent, we're saying that this is what's happening, this is what we're doing, they say, hey, these guys care so much about my business, these guys are trying their best, these guys are putting their effort. So majority of the folks are logical in these things, and people are at the end of the day emotional. If they feel that you are caring for them, if you feel that you're making efforts for them, then they reciprocate it, saying, yeah, it was great. They did the best they could and helped me out, right? Versus nothing happened at all. So I'll say it's actually better than nothing happening. Then you had an issue, but you came out of it winning, right? Same with investors. We are very transparent that this has happened. This is going to be the impact. This is the impact of the next 3-6 months, and this is what we are doing about it. And internally, we spend a lot of time figuring out, okay, for any startup, growth is a driver. Like the majority of the org is focused on growth. The amount of efforts you have to spend to just BAU maintain is fairly small component of how much we spend on growth. So there are at least 400 people whose jobs are related around onboarding new merchants, either support or sales and so on.
Yeah.
What do they do tomorrow? Right. So we had to restructure a lot of our people, a lot of our teams to reprioritize other areas, to reprioritize things that we were discussing earlier, like things like Razorpay, payroll, offline, other things, and see how can we leverage them.
Utilize them elsewhere.
Right? Because we knew it was going to come back, and how do we keep the teams motivated? How do we keep the teams excited and focused on improving the things that we can improve, things that are in our control? And we gave that view to our investors that, hey, this is how we are restructuring our org. This is what we are focusing on right now. And most investors were fairly appreciative that this is like you are doing the best you can, and you're trying to deal with the situation the best way you can. Let me know how can we help. And I think we took a lot of their help as well, a lot of their advice as well. I know I spoke to you and AJ and folks that, hey, this is what we are thinking of doing right now. What do you feel? And a lot of inputs would come from investors that, hey, why don't you try this as well? Why don't you try that as well? So involve people in the problem, help them be part of the solution. Otherwise, of course, by default, people will be like, we don't know what's happening with Razorpay.
Yeah, sometimes, especially I find in India, but everywhere for that matter, if there's silence, people fill it with negative thoughts.
Yeah.
Whereas if you say something and here's what you're doing, like you're saying, then they can engage with that and do something about
because if people don't like being blindsided, I think that's the worst feeling you can give to customers, partners, investors, anyone. That, hey, something like this big happened and you didn't even tell me. Like, that's the worst thing you can do.
Yeah, there's a bit of trust broken at that point.
Yeah, and goes back to the trust condition. That applies to everyone. Right? Like, you break that trust and suddenly they know that this has happened. They heard from somebody else in the market that this is happening with Razorpay, and them as an investor don't know this. Of course, they'll be unhappy.
there's almost like a not just a customer brand that companies build. There is an investor brand that they build, and there is an employee brand that they build, and they're all connected in a way.
Yeah.
But a lot of that is informed by just the right moves at the right time. Transparency is one of them, etc., etc. But that's a good one. That leads me to one of my last questions on culture. Razorpay, you're known for 7 days a week. People are working hard. I don't know if you have a work at office policy or work at home or where it is, but how do you think about building a positive culture where people are working so hard all the time?
Yeah.
7 days a week or 6 days a week is a lot. And there's all been discussions on various social media forums about how much people should be working or not working. But how do you think about building a positive culture at Razorpay? What have you done? What are a few things that founders can take away to build positive cultures in their organizations?
Yeah. I think a lot of discussion we had on investor and customer side applies here as well, which is again a principle of trust, right? Like what kind of relationship we build with the employees, right? For example, we don't really have while we have work from office policy, we don't really have a 5 days, 6 days, 2 days as a structured policy. What that means is that if you're working hard and something is critical, you yourself. So the kind of culture you create is that there's an outcome-driven culture. That this is the outcomes that you're chasing. These are the outcomes that we are chasing together. That's right. For example, we had an FTX, which is our largest conference last week. A lot of people spend their nights and evenings and everything else building up to that. So for 2-3 weeks, people were in office at night, late nights, working through this. Nobody told them, hey, come at 2 a.m. tonight and build this. That's not the culture we have. People just showed themselves because they wanted to make FTX a success. They wanted to put their best products out there. They want to put their best videos.
How do you build a culture like that?
Yeah, so you give people that opportunity that, hey, this is a platform. This is the largest conference we're going to have. If you build a really strong product or a really strong video right now, it is going to get launched at FTX. Otherwise, you'll miss that window. And people want to fight for that. So for example, FTX started as a way for people to launch products. Initially, that we wanted to create a platform where we launch products. It reached a point where there's so many products that people built for FTX that we had to do an internal conference, what you call an FTX Insider, because not every product can be shown at FTX. So there's a limited window. People have limited bandwidth to capture. So we can do 5-7 launches, but we actually internally built 30-40 new products for FTX.
And like a razor tank, like a Shark Tank.
So we do an internal, what you call FTX Insider, where all of these products are presented to me and the leadership team. And the ones that we love are actually present, or ones which have the biggest impact are presented at FTX. The others only take okay, we launched this a couple of weeks after FTX, we launched it and 6 months later, and so on and so forth. So that's the kind of culture that we
instead of giving people the opportunity to shine if they want to.
And most people want to. Right? Most people want to. Like nobody likes doing just a 9-to-5 job and go home, right? And that's not why people come to startups for. If people like that, then they will never come and work in a startup. You'll go work in a large MNC and do your job and go home. The reason most people come to startups is they want to outshine. They want to get inordinate amount of recognition, inordinate amount of opportunity, and inordinate amount of wealth creation. And all those 3 things is the primary reason people choose to join a Razorpay versus, let's say, a large MNC or a large bank and something like that. And if you're not giving people that, then that questions of work-life balance and all those things come in. If I'm just doing my 9-to-5 job, why should I do a 9-to-9?
Exactly.
And that's fair for an employee to ask. So if your job is boring, mundane, repetitive, then people would want to do it in a limited period of time and go back to home and do it.
I agree with you that. I would add one point to it. I think giving people opportunity to shine is one big area. Another big area is helping them buy into the problem they're solving. I think especially in engineering, we find that if you're telling somebody, a new engineer, that, hey, you can come here and work on AI or something, you'll find people who want to work on AI, they'll work on it, they'll move on to the next company. But if you help them buy into the problem that you as a business are solving, yes, it's solved by some part of AI, something else, they'll figure out the way to solve it, but the method is not the thing they buy into. They buy into the problem. I'm trying to solve a supply chain problem. I'm going to solve India's payments problem, whatever it is. Then that we find is really much more energizing year after year. Versus technologies.
I completely agree. I think so. I've spoken to people who have gone through burnout and stuff, and the most common reason burnout happens is never because of timings or because of how many times I'm coming to office. Burnout happens when you're not finding meaning in your job. And that's the most common reason. If you're doing the same thing repeatedly every day, and it's not exciting, it's boring, then it doesn't matter whether you're doing it for 2 hours or 8 hours. Like people just get burned out. For example, a lot of us would get burned out during COVID. You're doing the same thing repeatedly, attending meetings and all
20
day.
Zooms a day.
Not meeting everyone, you're not learning anything of value, you're just doing the same thing repeatedly.
Yeah.
That's one of the reasons I think work from office is essential, because it's very easy to burn out in work from home. You're doing the repeated thing over and over. There's no coffee conversations, there's no hanging out, there's no playing TT with your friend for five minutes, or going out for a movie at the end of the day. Like, it's just work, and that is the primary reason burnout happens.
Yeah.
When there's no meaning to your job.
Yeah, makes sense. I'm going to shift from the timeline to two final questions, which are not Razorpay specific necessarily. One is, since you're a platform, you see all sorts of commerce and payments across India. Where are you seeing new high growth segments of transactions emerging in India these days, from your vantage point as sort of, across the digital economy in a sense?
Yeah, well, there's like we call ourselves internally like we are an index of all the digital growth that's happening.
Right.
So if digitalization grows, then we grow with it, and at a macro level, that's been growing quite consistently. But the areas where this is growing keeps changing. So COVID, we saw a bunch of growth on things like EdTech and digital services. Last year and this year, we've seen aggressive growth on the travel side.
Travel.
It's supply constrained. Honestly, the growth could be even faster if we had more supply. But travel has been growing aggressively.
And travel specifically, like within India, outside
both.
India, any specific modality?
Everything. I think this across the general flights and hotels and trains is known, but even luxury travel services, which is things like customized travel packages and so on, it's gone up significantly. Where people are sending their parents and others to visit. I think it's an outcome of COVID phenomena where people are locked inside and now they want to use the rest of the time to travel. So that's one area. One unique area that we've seen is, I think, 2015 to 18, we saw aggressive growth in e-commerce, which is the horizontal marketplace side. I think in the last 2 years, we've seen a lot of growth in verticalized niche D2C brands.
D2C brands.
I think what people realize is horizontal marketplaces are great if you want to find the cheapest way. The initial sell of e-commerce was that this is the cheapest product that you can find versus a neighborhood store. But I think we are now seeing a significant portion of population which has a disposable income, that they don't want the cheapest product, they want the highest quality product. And for that, people are learning that you need to find the right brand and buy from the brand.
Okay, so travel and D2C brands.
D2C brand, that's aggressively growing because people are trying to find specific brands that are high quality. Of course, Mamaearth is a great example, where there are so many more coming up now in specific segments like luggage and so on. And so yeah. The third big area that we're seeing now growth is, of course, the markets themselves, which is securities and mutual funds and all that. But we're also seeing a lot of growth on the wealth management side of things, which is companies who are specifically catering to people. Again, this is an outcome of rising disposable incomes, people who have enough wealth. How do you manage it? How do you handle it in the best way? I think that's the third area. The last big area that's upcoming and growing now is, of course, on things with companies which are using AI to differentiate themselves.
Such as in India?
In India as well. So we are seeing companies come up there's recently a company that was doing really well is in the medical sector, which is using AI on doing your health checkups and diagnostics.
Okay, so remote health, telehealth.
Yeah, telehealth, diagnostics, all of those things. Health is an overall segment. The spending on that is going up,
okay.
Which is preventive health. So India was always a large health market, but never on a preventive side. Preventive health as a segment is growing up. Diagnostic was one which grew a lot during COVID, but now health packages, health solutions, AI-driven health solutions, all of that is growing up quite aggressively. So
it's interesting. You haven't mentioned quick commerce. Is that sort of a small phenomenon today?
It's a large phenomenon, but it's limited to 2 or 3 brands. It's not an industry, right? Like there are 3 companies or 4 companies
doing this.
Not a ton of merchants.
Like a Zepto and a few others.
Yeah, there are 3 or 4 large companies which are doing it in a massive way. There are small brands coming up, but they're yet to catch up. So I'll say, as a phenomenon, I'll not say it has taken up yet. It's 3 or 4 brands driving it aggressively.
Got it. Last question for you. At least there's been talk in the last couple of years of India Stack being exported abroad. I think UPI works, in Singapore or Dubai, and I don't know, some other countries as well. Certainly the Indian government talks it up abroad, I think rightfully so. It's been a phenomenal success. How do you think about opportunities for startups with UPI that cross borders into other countries? Is there an opportunity, or is it mainly India?
So UPI as an instrument itself going on cross-border will take some time. Right? So it's being primarily limited to Indian consumers who are traveling to those markets and paying with UPI. That's limited to Indian diaspora traveling there and so on. But UPI as a technology or as a concept going into other markets, that's a big change that's happening. So most countries in Southeast Asia, for example, have launched their own versions of UPI or UPI equivalent. So Thailand has Prompt Pay, Malaysia has Do It Now, Indonesia has its own QR system. So all of them are launching their own versions. So if you recently gone to Thailand, you'll see a QR code everywhere, like the way we see in India. That's happened in the last 2-3 years.
Yeah.
They built their own versions of UPI in different ways and different forms. So I think that format is growing everywhere. I think that's a big opportunity for companies like us. That's the reason we are going into a lot of these markets, because as UPI type instruments carry in these markets, because of the growth that we have seen on top of UPI in India, it's an opportunity for us to take those products in the same
You
markets.
have the products ready to go.
Yes.
In a sense.
Yeah. So what kind of industries get disrupted by real-time payments? What kind of industries get disrupted by QR code payments? We know that and we built for that. So it's an opportunity. Like an example I'll give is most of the successful internet companies in the world come from US because internet came from US. It doesn't like India's internet is not built by a US company. We build our own internet ecosystem, but because the technology came from there, so if you're a search engine, which was very popular in the US, you'll by default be very popular in India because you know what people search for, you know what people try.
Yeah.
And it is successful. Same for social media, same for mobile telephony, and so on and so forth. I think that's an opportunity that India can see on the fintech side. As India's fintech rails, infrastructure rails goes into and gets built out in various ways in different parts of the world, it's an opportunity for Indian fintech companies to carry their products there
and win in other markets.
and win in those markets. Because if you are a winner in India and on top of the ecosystem, you've tested and seen all the flows, all edge cases, all the kind of things people expect. So when you go in these markets, you have a very baked in product, which the market itself will take a lot of time to catch up to.
Thanks so much for taking us to this journey over the last 10, 11 years that Razorpay has gone through. I think there's a lot of lessons for founders out there. And as Lightspeed, we really appreciate the partnership with Razorpay and looking forward to many more years together. Thank you.
Thanks for doing this. And really appreciate the partnership Lightspeed has. And hope to continue to build together.
Thank you.